Why do people use whole life insurance? Another question is, why do people not use whole life insurance? There is often argument on one side or the other that it is the best place to put your money, put everything you can there, it's safe, liquid, tax-free, accessible, all this good stuff. And then you hear whole life insurance is garbage, stay away from that, it's going to be the worst decision you ever make if you go with that product. Why are they polar opposites? By consumers often we hear this, not agents and then financial advisors that fight with each other, because that goes on quite a bit as well. Why does that happen though? Why are there two opposite ends of the spectrum? Well, it really has everything and anything to do with the policy design at the end of the day. How do we set up a policy for maximum cash value, which we're going to get into in a little bit. But a main thing out there that we see quite a bit is uncertainty. Uncertainty with the product. Maybe you are considering a whole life insurance product. Let me know if you've ever felt like this. You are considering a product, you talk about whole life insurance, but then a friend or family member talks to you and says, you want to stay away from that. I was burned in the past, or I really dug into it and I just could not justify a reason to move forward with that whole life insurance product. It took 10 years to break even. I only had 50% of my payment in cash value in the first year. I had a nice death benefit, but that was not my goal. My goal was cash accumulation, and it didn't satisfy that. So again, you've been burned in the past, or I saw an illustration, it looked like garbage, did not satisfy my goals, but then we keep hearing that the wealthy use it. Big banks and corporations, if you look at the major players, the major banks in the United States, cash value life insurance is one of the #1 assets on their balance sheet. You can actually look it up on the FDIC website. They have to disclose that information, and you'll see a lot of smaller community banks use it as well. Point being is it is an extremely popular asset among them. They just position boatloads of cash there. And then as a consumer, we hear that and say, okay, why are they doing that? And I will say that a bank-owned life insurance policy, a pure product that a bank can obtain, is different than what an individual can obtain. With that said, what a policy an individual can obtain can be designed to mock very, very closely to what banks have in cash value life insurance, in optimizing the cash value from the get-go. So we keep hearing that the wealthy use it. And here's the big thing. This was me when I was new in the industry, is okay, people tell me stay away from whole life insurance, but then I hear all these oh so great things about it. Can you just show me what the big players do? You know, before I was fortunate, and I'm very fortunate that I was exposed to bank-owned life insurance and actually had the privilege of working with a bank, we work with one now and setting it up, is I wanted more than anything to see exactly how that product worked. Because an average insurance agent or financial advisor cannot just run a BOLI illustration and see how it works. It has to be requested, you have to be an approved vendor or agent in order to actually write BOLI or even produce an illustration. Often it's done by home offices. So there's several steps there before we can even get the numbers to see what it looks like. So I wanted to see it. Now in seeing it, you see exactly how these big guys use the money, how these products are set up, and then reverse engineering a traditional policy, you can do the exact same thing, or I shouldn't say exact same thing, very similar for an individual. So let's kind of recap this here, because there's a lot of uncertainty if we just look at you, an individual consumer looking to purchase a policy, burned in the past, or friend says stay away from it. Let me know if you ever heard this. I wish I would have known about this 30 years ago. We hear this all the time. When an individual finally sees how a policy works, what it looks like when we design it for maximum cash value, the response we get is, hey, why did I not see this 30 years ago? Or 10 years ago? Or last month when someone else showed me a policy option? Like, what's going on here? Quick example here. We're gonna rewind the clocks here 35 years, and we've got an individual that is proposed a whole life insurance policy that I would not necessarily recommend here. So 35-year-old male, not designed for maximum cash value, but he thinks that it was, from what he was told. So he's got a base premium of $4,000, PUA rider of $6,000. This has to do with the policy design. Our money can go towards one of these two areas, the premium or the PUA component, and he has what is called here a 40-60 split. 40% of his payment directed towards the premium, 60% towards PUAs, total out of pocket $10,000 per year. Cash value just under $6,000 in the first year, and what is highlighted in yellow here represents the break-even point between years 8 and 9. So this is with one of the 4 major mutual companies that we always recommend everyone should look at, even if we're looking at other carriers. These guys are good to consider because we've seen the actual performance delivered over time. $10,000 per year going in, breaking even or positive cash value by year 9. As time passes, funds up until age 65, where he has paid in $300,000 and he has $610,000. Fixed asset, safe, liquid, tax-free all the way through. So long term, it does compound and get better and better. Okay, but he decided not to do it because he looks at this and says, okay, I'm 35 now, 8 to 9 years just to get my money back. Like, that's not for me. I want to do more with my money. I want to have access to this $10,000, more of it to do things like pay off my debt, invest in real estate, whatever it might be, start a business. I need access to more capital right off the get-go. I'm trying to think long range as well here, but how do I get the best of both worlds, which you can easily get? Then, when he's 65, he takes another look at whole life insurance, very resistant to the idea of it. It says, okay, I was pitched on this 30 years ago, was a no-go at the time. I highly doubt that this is going to be a fit for me now. So, here's what we got. A policy with just under a 10% premium. Now we've got more than $10,000 per year going in. 30 years later, he's 65, has a lump sum of money. We're looking at how to move it into a policy in the most efficient period of time, which in this example, it's going to be 5 years. Total of $1 million he gets into the policy over 5 years. By year 4, he breaks even. The 10% premium here, he's got just under 19% in the true premium, but we have a term rider that is attached to the policy as well. If you have not seen any of our policy design videos or content on that, well, that does provide more information here. Really, a term rider, a purpose, or the purpose of a term rider, is it is often the most cost-effective manner to raise the death benefit, which primarily raises our MEC limit. And that really has to do with the IRS viewing a life insurance policy still as a life insurance policy, and I can utilize my cash value tax-free. If I violate this MEC limit and my policy becomes classified as what is called a modified endowment contract, the cash value grows tax deferred, but when I go to access it, I have to deal with taxes and potential penalties. No good there. So this is not a MEC, and it is why we have the term rider attached as well. Very important in that respect. Can do it at any age, really. But here's his cash value. Breaking even year 4, has the option to continue to pay into it beyond year 5, but he does not. Cash value just keeps on growing. He's got access to the cash value all the way through as well. So the question is, well, why wasn't I shown something like this 30 years ago when I was so much younger and I could have just had time to let it continue to cook the cash value that is? Has to do with the policy design. Other factors go into it. When you look at how a policy is designed, money can go toward the premium or the PUA component. And just to provide full transparency, when you look at compensation in the life insurance industry, the bulk of it is derived from the base premium, in particular in the first year. There are renewals as well, but that's where the primary compensation is paid. So if he could rewind the clocks, he might do something like this, where he pays into it $50,000 for 6 years. Maybe he continues to feed it, but he's cash rich right off the bat. Point being here, going back to the original question, is why do people use whole life insurance? Or the question, why do they not use whole life insurance? Why would anyone not do this? I would argue it's typically due to a lack of this. Can you read my handwriting? Awareness, lack of awareness. If I don't know what is possible with a cash value life insurance policy, I'm not going to be able to follow through on properly designing it. And the same thing goes for an agent. So, meaning we've got to be aware of how to design these policies and set them up where we're optimized for cash value, flexibility, but then also making sure we don't trigger a macro taxable event at any point in time, upfront or over the long haul. No, this is a lot of information. If you have any questions, feel free to reach out anytime. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.